We had a very mixed day in the market yesterday, with half of the stocks in the S&P performing fairly well, although we had another half of the story where companies were down, and that includes our main focus for today, which is Chevron Corporation, the oil and gas giant. Now this one trades pretty much at its 52-week low, around 20% down from its all-time highs of $171. And we also note over the last 12 months, it is down around 16%. And if you've been a long-term shareholder, well, over the last years, you would only be up around 10%. So we're going to take a look at this company in today's episode, but we also want to remind you of how they fared in just their more recent earnings. And we do also note here they in fact missed on the EPS, which we will take a look at with a clear indication here, the reason being the refining margins have taken a hit. So we're going to take a look at that, and one thing that we also want to highlight here is that the Chevron Hess deal is going to be delayed well into 2025. Now, in terms of how bad those misses were, well, what we can note here, they reported 255 EPS, with the market expecting quite a significant increase of 293, and we do note they did marginally outperform on that top line revenue, 51.18 billion versus 50.8. Now, the main thing that we also want to highlight from this analysis is the fall that they have seen in their profit, and that is essentially reporting a profit of 280 million versus the 1.1 billion that they reported just from the same quarter last year. In effect, a 74% decrease, which, as we mentioned, does come down to the much lower refinery margins. Now let's take a quick look at the company. We already discussed the movement. Now we do get a double buy rating, that is seeking alpha Wall Street, although we note the hold from Quant. This one also pays a fairly nice yield at 4.73%, and it also has a forward P of around 12. Now we will compare that to others in the industry. So let's take a quick look at some of their underlying metrics before we move further. And their dividend safety score sits at 90, very safe, very nice to note for a company with a fairly attractive starting yield. And what we also like is that in February this year, they did offer those shareholders mid to high single digit increases on those dividends. Now, what does it mean to have a 90 very safe score? Well, first thing we want to highlight, this was reaffirmed just last month, and ultimately it means that a dividend cut for Chevron Corporation is highly unlikely. Now, as we mentioned already, some of these metrics we're going to discuss. The first one here is the key metrics from the Great Recession 07-09, and what we in fact note was they did increase the dividend. They did have below average growth, negative 43%. Remember, the S&P at that time came in at negative 12, but we do note they did significantly outperform the S&P in terms of recession return, negative 34, S&P itself coming in at negative 55. Already mentioned, a very positive increase to the dividend this year, 6% over the last 5, 7% over the last 20 years. Very, very attractive, and one of the reasons why we do believe this is a very good company for dividend growth investors, not just because it's got 36 years of consecutive increases, giving it that dividend aristocrat status, but they have been paying dividends for the last 112 years without a reduction. Does make it very attractive for consideration, especially if you do use that yield as income. Now let's take a look at dividend yield theory. As always, states a company is undervalued when the current yield sits above the 5-year average. This is our first undervaluation signal, 4.73 versus 4.18 on the 5-year rolling. The same to be said for the forward PE, 11.3, so that is below the 5-year 12.1. That is a double undervaluation signal, and ultimately you could call it a triple undervaluation, as the forward PE is marginally lower than energy at 11.5. Now do remember, we're not looking at any one of these models in isolation, and we will conclude towards the end. Now, very important to understand, we do tend to ignore the earnings data on this channel, focusing on free cash flow, as earnings data is susceptible to manipulation by management through accounting, and below 40% is what we want to see for the oil producing industry. Now, bear in mind, with this company, it is a very cyclical industry, so you will see throughout lots of positives, lots of negatives, moving from peaks to trough. Over the last 3 years though, nice to note, around that 40% level, over the next 12 months at 48%. Therefore, we would expect that maintain of the very nice increases we have seen to the dividend at the mid to high single digit rate. Now, free cash flow is something we do like to see consistently increasing over the longer term. Very inconsistent for Chevron. We do know 3 years of negative free cash flow, but over the longer term it has been increasing. 1060 in 2023, 1370 over the next 12 months. But again, as a reminder, don't be surprised if we do see it fall over the subsequent few years. Then we get to sales growth, where it really does highlight that cyclicality. 3 to 7% is what we want to see every year. In fact, for this company, 6 of the last 10 years have been negative growth, notably 2023, the more recent year, negative 17%. Now, for those that like to see the numbers, well, we do in fact see 192 billion in 2014, down to the COVID lows of 94 billion, and back up to 195 in 2023. As we mentioned, lots of peaks and troughs on a year-on-year. In fact, only a marginal increase from 10 years ago at 192. We then draw your attention to the shares outstanding. Remember, returning excess cash to investor pockets is what we want to see management do through those share buybacks. To be honest, CVX net position over the last 10 years, very minimal share buybacks, and they've done both issuing of shares as well as buying back. Very trivial movement in terms of the net position, so we won't talk too much about that today. And then we get to the ROIC, one of our favorite metrics, 10% or more, which they have produced or thereabouts over the last 3 years. As always, that does reinforce our faith in management and their ability to effectively allocate their capital. Then we get to the margins. Now, maybe not particularly attributable to this company, but we want to see companies that in general increase their top line as well as their operating margin for that efficiency. We note it is above 12% over the last 2 years and on the trailing 12-month basis. But again, do bear in mind the cyclicality nature does show right across the numbers. In fact, we note negative margins 3 of the last 10 years. And the same can be said for the free cash flow, negative from 2014 to 2016, although since that point, at least around the minimum we want to see of 5%. Then we move to the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 1.5 for the industry. Remember, the numbers below do indicate the number of years it would take the company to pay off all of their debt net of cash on hand. And ultimately, it does essentially correlate to dividend strength and balance sheet safety. 0.4 in 2023, thereabouts over the next 12 months. So Chevron does have a fairly strong balance sheet, and no surprises why we did ultimately see that very safe dividend score. Now, we also on this channel like to look at some movements, both insiders as well as institutions. We'll start off with insider movement in terms of 0.2%, so very trivial. And in terms of insider selling, well, 3.18 million over the last 12 months, no buying over the same time period, and you would have to go to around Q2 to see that amount of selling. Again, for those that are interested to see who they are, in fact, we can see the Vice President, Jeff, did sell on the 21st of May, so quite some time ago. You could argue pretty much outdated for this analysis, around $601,000. Also, we would say that insider selling isn't necessarily a bearish signal, as they do sell for many reasons. Could be personal, could be financial. Then we get to the institutional side of things, 72% ownership, around 10.5 billion worth of sales over the last 12 months, around 18 billion, so a significant amount more during the same point. Now, in terms of the more recent quarter, well, Q2 we see marginally more buys than sells. Q1 we see the opposite, marginally more sells than buys. Overall though, institutions over the last year have been buying a lot more than they have been selling. But ultimately, whilst we do like to incorporate this as one piece of our analysis, we should never focus on this, never copy insiders, never copy institutions, and always do our own due diligence. Now, we also want to remind you, we have released our latest weekly article. If you want access to this or any others, do check them out by clicking on the pinned comment below. We have also released our 25 undervalued stocks for your consideration in the month of September, where we also run through each one and document those that also sit within our own portfolio. So do click on that pinned comment and do sign up straight away. We then move on to their income statement. Now, we did run through their top line, but we will just show it again. A lot of inconsistency on a year-on-year basis. And in fact, from 2014, if you just look at that number in comparison to 2023, it has barely moved. But the reason why we focus on this part of our analysis is that bottom line net income. Is there a similar story? Is it a little bit different? Well, in terms of the essential graphical basis, very inconsistent. 19.2 billion of net profit in 2014, 21 billion in 2023. So very marginal increase over the last 10 years. And in fact, in a year-on-year comparison, we do note some years very good, some years in fact a net loss, and in fact 2022, as we can see, one of their best years. So just understand the cyclicality nature that does come with this industry and do factor that into your margin of safety. As always, we want to be buying companies when investors tend to be selling, when these companies tend to be at the bottom of the cycle. Now, a quick health check of the company: total cash versus total debt, 13.2 billion as we can see in 2014, 4 billion in that latest quarterly report. So their cash has been trending downwards over the last 10 years. Ultimately though, this number in isolation isn't a bad sign, isn't also a positive sign, because we need to compare it to get some useful data, which is why we look at the total debt both numerically and directionally. And as we can see here, it has in fact decreased from around 27.8 billion in 2014 to around 23.2 in the latest report. So very nice to note, total debt over the last 10 years has been decreasing, but again, do look at this in terms of cyclicality. We see some years where it does spike up, but ultimately over the last 10 years, we do see some marginal decreases. And as we saw on the net debt to EBITDA basis, the company overall does look secure. Then we take a look at their earnings. How did they perform historically? How are they looking to perform in terms of expectations? Well, over the last 4 quarters, they have only beaten twice, so a 50% track record. And as we just ran through at the beginning of the episode, a fairly large miss in Q2 of 2024. We do also note the next 2 quarters are anticipated to be negative, followed by 2 positive quarters. But ultimately, the earnings per share is anticipated to increase 13.59 next year, with that bringing the forward P down to around 10.14. But ultimately will depend on whether or not you have faith in management and their expectations moving forwards. Now, in terms of some gradings and underlying metrics, valuation, they get a C-. Now, we can see the P on a non-GAAP basis of around 12 is marginally higher than the sector median of 10.9. So that is a 10% if you want to be numerical about that. So just bear in mind then, if you are buying this company in comparison to the sector, you are paying a fairly small essential premium. But when you do look at other metrics, again, that is pretty much the case for the majority. You are paying a fairly small premium for this company, whether or not you use the forward P or any other valuation method. Then we take a look at the growth grade, where they get a D+. Now, revenue year on year, negative 9%. Whilst the sector was negative, we do see a smaller rate at 2.75. Moving forwards, negative 7%. Although now we see something different. This sector, whilst very small, still expecting an increase to their top line. And we do also note, when looking at the earnings per share over the next 3 to 5 years, 5% expected growth, with the sector marginally higher at 5.91. So at the moment, it doesn't look good for Chevron. Valuation is higher than the market, although we are noticing the growth is expected to be lower. However, when we do come and look at their profitability, they get an A+. Now, gross margin around 40%. That does come lower than the sector median of 45%. Bottom line as well, the same thing to be said, 9.6, whereas the sector comes in at 12. And we also note cash from operations, 35 billion, significantly better than the sector of 562 million. Probably the main reason why we do get that overall A+ grade. Now, quick conclusion for this part of the analysis: a double buy from CE Alpha and Wall Street with a hold from Quant, C- on valuation, D+ on growth with an A+ on profitability. Now let's have a quick look at how they've performed against others in this industry. Very big names. We have Shell, we have Total Energies, as well as a few others. Now, over the last year, bear in mind, this includes reinvesting those nice dividends. Chevron are down, one of the worst performers at 12%. What we note here, it isn't something that is industry specific, as only 2 of the 6 have reported negative. And then when we look over the last 5 years, we actually see Chevron again at the bottom 2, up around 42%. When we expanded over the last 10 years, we can see Chevron up around 69%. But ultimately, what this shows us within the industry as a whole, over the last 10 years, only a few have been what we would say semi-decent returns, around 149%. Now, bear in mind, this is what they've returned on a historical basis. It doesn't mean it will be the same over the next 10. It could be a lot better. Look, in fact, it could be much worse. So just something to factor in when you are considering this company. Now let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $173, how we've got this? Well, we have run it through the 4 valuation models. The first one, Graham's valuation, the earnings per share, long-term growth rate with the AAA corporate bond yield. With the market value at 138, the intrinsic value from this model gives 144. We have our first undervaluation signal, but do remember we're not looking at any one model in isolation. We then have the multiples valuation model. Some companies in a similar sector and size, their average P multiplied by the EPS of Chevron to give an intrinsic value of 131, which is lower than the market value, giving us that overvaluation signal. So 1 for 1. Then we move on to the dividend discount model. Now we have the growth rate year on year, average around 6.5, the more recent one at 7.95. We have gone a lot more conservative in today's episode at 5%, and as we do know, nonetheless, we still get an undervaluation signal and quite a significant one, making it 2 for 1. We then get to the discounted cash flow model where we have the free cash flow year on year, average growth rate very high, but again skewed, very large movements on a year on year basis. We've gone for around 2% moving forwards. With a discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get our third undervaluation signal. So the intrinsic value in today's episode is the average of these 4 models that we've just run through. And remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for Chevron or any others. Then we do a margin of safety. As always, we start off with 10% and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, it is a buy at around $155. Then we keep going till it's near the current trading price. And we can see in today's episode at the 138 mark, you are getting a 20% MOS. Whilst we also know Wall Street very bullish, as we said, a buy signal, their price target $179, they see upside of 30%. Now for some people 20% may not be sufficient, so just to show you, the 25% mark would be around 130 and 30% would be around 120. But as we said in today's episode, 20% margin of safety with 30% upside according to Wall Street. As always though, do let us know your thoughts in the comments below. Is this company one you are considering? It's been paying dividends for more than 100 years. Very nice starting yield, especially if you do believe interest rates will start to come down quite significantly over the next few months. Or is this one that maybe is going to be on the watch list? Or in fact, maybe you are looking to sell oil stocks moving forwards. As always, don't forget to sign up to the free weekly newsletter below and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.